to a new topic, and this is this idea of quasi-reorganization. In this recording, I cannot show you an Excel spreadsheet. So I can't open my Excel spreadsheet, but it is in Canvas. You can look at it. But I can talk about what happened. So the company in this situation is when a company has undergone financial difficulty, a lot of financial difficulty, but has some valid, favorable future prospects, okay? Just saying things are going to get better would not be enough. You'd have to have some very good evidence that things are going to get better. And they want to get a fresh start without going through the courts. Okay, but then some, state to state will say what percentage of the shareholders have to approve this plan. So you can't just sit in the office and say, hey, let's just do a fresh start and wipe out our negative retained earnings. So if they've undergone financial difficulty, what this presents itself in the financial statements would be a big negative retained earnings. So a fresh start means we want to wipe that negative away and just get to a zero retained earnings like we were a brand new company. To do that, we're going to revalue those, all of our assets and liabilities actually to fair value. And then we're going to get rid of the negative retained earnings by using other equity accounts to absorb those losses. Okay, in a nutshell, that's what we're going to do. We're actually going to do it through 3 steps we talked about in class. Those 3 steps to make it happen are we are first of all going to bring the assets and liabilities to fair value. So that's the first thing we're going to do. The second thing we're going to do is we're going to look to those other equity accounts to absorb the negative retained earnings. So to the extent it can all be absorbed into our paid-in capital accounts, that's what we're going to do first. And as a last resort, I guess, as the last place, we're going to use our common stock account to absorb any retained earnings. And when we do that, we're going to have to adjust our par value most likely because, up until this fresh start, our common stock account was our number of shares times the existing par value. Now, if we mess with the dollar amount of common stock, we have to back into a new par value that fits, okay, because we're not changing the number of shares. Okay, so just make sure we understand that. That's why you have to get the shareholder approval, right? I'm not changing the number of shares, but I am changing the par value and the paid-in capital that's in this company. All right, so that was the build-up, I guess. This is actually looking and going through the journal entries that we're going to need to do. So here's the information about, I just made up Emerson Corp. It's not an Emerson Corp that you are familiar with. It's just made-up numbers. Okay, so there were losses for several years, and the board of directors voted to have a quasi-reorganization. And so this is the balance sheet before, and you can see that there's a negative retained earnings here of negative 300 million. We have assets, we have a liability, we have some common stock, and some additional paid-in capital. So we have some information because step 1 is to bring the assets and inventory to fair value, or the PP&E in the inventory. So we see the fair value here is 250, and the PP&E fair value is 100. If you look at the inventory balance, we have it listed at 500, and we have the PP&E at 200. So entry number 1, if you will, is going to adjust those fair values. So I'm going to do that with a credit to, I'm going to do first a credit to PP&E, and I'm going to do a credit to inventory. Okay, for the adjustment that's necessary to bring those balances to fair value. So for PP&E, that was a credit of 100. For inventory, that was a credit of 250. Now when we're doing these adjusting entries, everything is staying on the balance sheet, so we're not using any income statement accounts. Because ultimately, if we put things in the income statement, they're going to be closed to retained earnings, so let's just go to retained earnings straight away. So we are doing a debit to retained earnings. I'm going to show you just a T account for our retained earnings. And so what we just did is an entry that actually made our retained earnings even more negative. Right, so entry number 1, when we made that fair value adjustment, it brought our retained earnings even lower. Okay, so that was entry number 1. And entry number 2, which I'm going to have to squish up a little bit because of my big blue line here, I'm going to make an entry to use my paid-in capital balance to the extent that it exists to absorb this retained earnings negative, which is now $650. So I look at the balance sheet, I see I have $200 in paid-in capital. So this entry is pretty simple to do once you know what it is you want to do. I'm going to use that paid-in capital to absorb some of that retained earnings loss. So I'm going to debit my paid-in capital for the whole $200 that's there, and I'm going to credit retained earnings for the same amount. Right, so once I do this entry, I'd come up here to my little retained earnings T account, and I'm working on it, right? We've made a little bit of progress towards bringing it to 0. So that's going to be my second entry, and then finally my third entry is I'm going to use the common stock to absorb the rest of that negative, which if you look at the T account, we had $650 debit, $200 credit, so it's a $450 debit is what's left in there. That's the amount of my entry. So again, I'm using common stock to absorb that negative retained earnings. So my debit is going to be to common stock for the $450 that we need to get rid of and retained earnings negative, and that's my credit. So if I look at my T account, now it's 0, right? Now I've gotten rid of the negative balance. Okay, so that takes care of it. Now if I was going to prepare a new balance sheet, how am I going to do that on this paper, on this sheet? Let's just put my new balance sheet balances over here. I'm going to have to be able to follow the lines. Sorry, my T account's in the middle. But basically what you're going to have is $300 in cash. Go away. You're going to have $250 in inventory because of entry number 1. That does say $250, sorry. You're going to have $100 in property, plant, and equipment. So if you add that all up, you get $650 in total assets. If you look on your liability side, you have $200 in liabilities. You now have $450 in common stock. You have 0 in paid-in capital and 0 in retained earnings. So you'd have $650 in liabilities and owner's equity. I know that's a hard to see my balance sheet because this retained earnings T account is right in the middle. That's kind of the point. This is 0, is what we wanted. We started out with a negative 300, and now we're at 0. That's the way the quasi-reorganization works. All right, we have a little bit of a quiz, just reinforcing those ideas.